Hello everyone and welcome to the second of our finance webinars developed as part of the Money Matters series. My name is Aileen Deasy, Manager on the Enterprise Development team, and we are delighted to bring you this really important finance webinar today. So thanks a million for taking the time, and great to see a lot of businesses taking part in this today. So this is a really important area for all businesses as we move from survival to recovery. We are acutely aware of the challenges that you've been facing with rising costs and the impact of all of this on the bottom line of your business. So therefore, to help you navigate the current financial environment, this webinar is focusing specifically on managing your cash flow and repairing the balance sheet. So we're absolutely delighted to be joined by our two experts today from Crowe. So we have Maria Doyle-Balfe. So Maria is Director of Hotel Tourism Leisure in Crowe and has over 20 years experience in industry and consulting experience in the hotel sector, also in tourism and leisure industry. She has held senior management positions in the hotel sector and the tourism sector, and has an in-depth knowledge of this sector, both operationally and financially. Aidan then is a partner with Crowe, working in the corporate finance department. He is a fellow of Chartered Accountants Ireland and a member of the Representative Committee of Restructuring and Insolvency Ireland. So Aidan's expertise is particular in relation to debt financing, business liquidity, cash flow management, capital appraisal decisions, and strategic business planning. So we're in good hands to talk about this very important area today, and I'll hand over to you now, Maria.
Thanks, Aileen. So I think we'll just get started and we'll go straight into the topics that we're going to discuss. So really what we want to do first is give a market overview. So really looking at the external environment and how that impacts the food and beverage industry and sector within Ireland. And then look at that sector itself, you know, the various bars and pubs and restaurants, like what's the scale of operation within Ireland? And we're then going to move into a scenario and really want to look at what's the impact of COVID from both the profit and loss account looking forward to this year, and then the impacts on the balance sheet and the cash flow, and then really looking into how we can manage our cash flow and I suppose what's next for the sector. So I think if we look at the market overview, so looking at the different types of offerings within the food and beverage sector in Ireland, you know, what do we have? We have a good diverse range of offerings, you know, everything from takeaway to gastro pubs to cafes, you know, fine dining restaurants, food tours, which is great, and certainly some of the activities have food offering as well. So really diverse range of offering. And what does that mean? You know, we have over 4,000 pubs according to the VFI, you know, over 2,700 restaurants, cafes and gastropubs in Ireland. They're a really crucial part of the tourism sector, both domestically and international. And definitely what we saw during the last 2 years is there was a lot of innovation in the sector. And certainly while it was one of the hardest hit within the hospitality industry, we really saw a lot of innovation through the pandemic. So I suppose taking a macroeconomic view, Aidan, there are 4 areas that, you know, I suppose you're going to just maybe touch on today and give us some thoughts on those and how they'll impact the sector.
So in terms of, I suppose, the post-pandemic economic recovery, we're into a period of, I suppose, a strong rebound in business for most of these food and beverage outlets. When I talk to them, their ambition, I suppose, is to get back to 2019 levels. But there's a recognition that, you know, the world is a very different place, especially in terms of the cost base, I suppose, for their businesses. And, you know, in terms of, I suppose, you know, the cost base, it's much higher than it was in 2019. We've had, I suppose, the supply chain disruptions, which not only, I suppose, impacts produce, but also, I suppose, on services. And one of the larger services would be, obviously, labour costs. So, you know, finding it difficult, I suppose, to get staff and difficult to rebuild teams, and staff are more expensive. And while the wage supports have been great over the last 2 years, during 2022, we're going to see the full payroll cost coming through within these businesses. And it's a big jump in costs that they have to deal with. Equally, insurance costs have gone up for these businesses, probably going up more than their pricing is going up, so therefore it's eating into the profit. And I suppose the big cost in terms of light and heat and energy costs for these businesses up maybe 20–30%. So against, I suppose, this kind of backdrop, profit will be under pressure and cash flow will be under pressure. So while revenues are recovering, getting back to where they were in 2019 is still, I suppose, a journey as such. And then I suppose how quickly will some of these supply chain disruptions, I suppose, unwind themselves. But certainly in terms of the Ukraine-Russia war, energy costs to me will be higher over the next 2 or 3 years as there's less supply and there's supply-demand imbalance in terms of oil and gas. I think that will lead, I think, to a focus on sustainability. I think their customers will be looking at making changes to their daily lives, how they use less energy, and therefore if they're supporting businesses, they'll also want to know how they're using less energy. And the businesses themselves will be looking to reduce costs, and therefore how do you invest or how do you reinvest in the business? And I think sustainability initiatives will become a much higher priority in the knowledge that energy costs will remain high for the medium term.
Okay, thanks. A lot of challenges then facing the sector, I suppose. But from a demand perspective, maybe we'd talk about domestic tourism, which was really important to the industry over the last couple of years. We can see that 2019 was our peak year. Any thoughts on where you think or when you think the domestic trips will get back to that 2019 level?
Certainly, again, across most of these outlets, tourism, either domestic or international, is a very important component of their overall revenues. So if the ambition is to get back to 2019 levels, well, then we need to, I suppose, look at kind of what's the trend over the last 2 years, what might happen. So I would expect that 2022, there'll be a strong rebound in terms of domestic trips. I think there's pent-up demand. There's certainly, I suppose, good savings on deposit, and I think that will help the food and beverage businesses in terms of regrow their turnover. Equally, I think the consumer, though, is conscious about what's around the corner, and that will have a dampener effect. So I think we're still 2 to 3 years away from getting back to 2019 levels.
Okay, and then what about international visitors? Do you know any drop that we're going to see in domestic? Do you think that that'll be made up then by the international tourist market or visitor sector?
Again, I suppose looking at the graph, we can see that longer term you'll be very positive in terms of any other previous setbacks. We've come back stronger, we've grown numbers higher, and I think that will happen again. I think it's a question really of time. Will it take 2 years? Will it take 3 years? I think ITIC could probably have done a good bit of work on this and help kind of inform where these numbers might be. So here, ITIC have a negative case in terms of a slow return to previous levels. They have a base case and they have a positive case. And what we're seeing in terms of arrivals during 2022 is that they're tracking about 35% behind 2019 levels. So that would leave us at about 6.3 million visitors for 2022. So we'd be ahead of the base case, but the base case is really telling us it'll take till 2025 to recover to the 9.6 million that we had in 2019. And therefore, again, I suppose, the strength of the market that was there in 2019, either from domestic tourism or for international tourism, will take a number of years to get back to those levels.
Okay, so I think what you're saying is, like, when you're doing your budgets and forecasts, really think about the number of consumers or the number of tourists, if particularly if you're in a tourism location, to be cognizant of that and budget as accurately, I suppose, as possible, and then forecast as well based on how the trends are happening and based on what we're seeing, from tourists coming in. Okay, so maybe we would look at the scale of the operation in Ireland. You know, what does that look like from a regular, or I suppose a typical type of food and beverage operation?
Yeah, and we would see, I suppose, lots of businesses, you know, turnover could be anything from 200,000 or 300,000 up to 1 or 2 million. But let's say we take a kind of an average business that's doing maybe 10,000 euros kind of per week. So pre-COVID, it was doing 500,000. Its costs were 420,000. Its EBITDA was 80,000 euros. So it was getting 16%. So it was getting, for a food and beverage business, a decent EBITDA out of the 500,000 turnover that it was doing. So I suppose what the figures are telling us is that most of these businesses will take a few years to get back to 2019 revenues. So for 2022, we're looking at getting back to 90%, so 450,000 euros. I think the big change that we're going to see here is going to be costs have increased. And I suppose what we're trying to illustrate here, well, if there's a 10% increase in costs that have to be absorbed with a business, what impact does that have on the EBITDA? So costs would come out at 416,000 and EBITDA would be at 34,000 euros, EBITDA being net profit as such. And the net profit percentage would be 8%. So we can see here, I suppose, that profits, you know, could have, and profitability could have, and I suppose another way of looking at these businesses is that their cost base, you know, pre-COVID was 84% if their EBITDA or net profit was 16%. So a slight change, I suppose, in costs that they need to absorb has a very big impact on their profits. And therefore, I suppose, finding ways to mitigate the impact of rising costs and, you know, not have the profits fall as far as they might. This is a huge priority for these businesses.
Okay, and I think actually, you know, that 50,000 difference in EBITDA there, like that's a lot for this size of business, and obviously, you know, that's increasing in real terms. You know, the higher, the larger the business, I suppose, but in percentage terms, you know, if you've got a good, better sized business, you probably have a little bit more economies of scale, so the percentage mightn't be as significant. Would that be correct?
Yeah, I think what you'll find is that the lower your net profit margin would be, so if it was 10%, it would have a more significant impact than what we have here. But if your business was earning maybe 25% net profit, it would have a much lesser impact in terms of the cash. It's because it's the percentage of your cost base, and the higher your cost base, the more impact it has on your net profit.
Okay, so getting back to your point of the 80+% costs, like it's really trying to look at that and manage that. Okay, well, let's take a food and beverage scenario. So we have here a restaurant and bar. We're called it Crowe Restaurant and Bar. Obviously, it's a real, it's a fictitious business, but we've tried to make it as real as possible. So regional Ireland location, good location. Its revenue of about €500,000 up to €1 million. You know, property requires some upgrading, but it's high level of payroll. It is an F&B business, and a high level of overhead costs. So I think we'll start by looking at the P&L and tell us what we see here. Obviously, we have what was achieved in 2019 and 2021, and then the business forecasting out to 2022.
So I think it's important, this was to see where this business was pre-COVID. So our 1.1 million in revenues were 800,000 in food, 300,000 in beverage sales. So like a 70-30 sales mix as such there. With cost of sales, we're at 27%, and we had other direct costs of 2%. So we're getting a gross margin of 71%, and most of our costs are classified under payroll costs or overheads. Payroll costs were the most significant cost at 425,000 euros, or 39% of revenue. Overheads 140,000, or 13% of revenue. And we were making a very healthy 215,000 euros at a 20% EBITDA conversion. So this was a business, you know, that was in a good state pre-COVID. COVID then we can look at in terms of the year 2021, when business started to recover. but we only managed to do half of the turnover we were doing pre-COVID. Sales mix more or less the same. We lost a little bit in terms of gross margin because we're not operating at the levels we were operating at through lower economies of scale. Our payroll costs were well down in monetary terms, 170,000 euros, because we were able to avail of employment wage supports. So we had a subvention or a subsidy for our payroll coming through. And our overheads, because we limited some of our opening hours, we were able to save on some of the overheads, and they were down to 110,000 from 140,000. But percentage-wise, they were higher at 21%. We managed to make 80,000 euros, mainly on the back of the fact that we had these payroll cost supports and 15% profit. So now we budget in 2022, and we're looking at maybe it being, I suppose, conservative, potentially budget, but we're looking at what can we recover revenues to, and we believe we can get to 90% of pre-COVID levels, 950,000, now that we're fully open. Again, I suppose we're looking at 68% gross margin, so that's kind of typical of the previous years. But I think the number we're focusing on here really is kind of what's happened within the business. Payroll is a lot more costly for us, so we can see our payroll cost percentage is 44%, and pre-COVID it was 39%. So our payroll is up over 15%. Our payroll cost for the year could be 410,000 euros. And our overheads, now that we're fully open, because we have higher energy costs, higher insurance costs, and all other costs have gone up. Even though we're not doing 2019 turnover levels, our overhead will actually be higher than they were in 2019, 145,000 euros. And therefore, our net profit or EBITDA is 95,000 euros or 10%. And I suppose we have to compare that to where we were pre-COVID, because it's a very different scenario for our business. And it really means, I suppose, we have to manage this profit and loss account really carefully, because if the profit is lower at 95,000 euros, that means the cash flow coming into the business is lower. And is there enough cash to come in to sustain all the needs of the business? And therefore, looking at ways to reduce payroll costs, looking at ways to reduce overhead are key in terms of increasing, I suppose, the profit level and increasing, I suppose, the profitability level in the business back towards where it was in 2019.
Okay, thank you, Aidan. And I think actually in talking about those overheads there, something that not all food and beverage places do, not all restaurants or bars, is to categorize those overheads. So they're really understanding where the costs are coming, where those increased costs are coming from. So looking at it from an admin perspective or sales and marketing, utilities and repairs and maintenance, I suppose getting a better understanding of those costs. So let's see then, what's happened to the balance sheet. What the impact of COVID has had on that, comparing 2019, for example, to 2022.
So I suppose on the balance sheet, we have our building and equipment at 1 million in 2019. We had bank loans which were secured against that of 600,000 euros. We had trade creditors of 55,000 euros, and we had tax liabilities of 20,000 euros. We had 50,000 euros in the bank. So we were in good shape, I suppose, at the end of 2019. Roll forward, I suppose, when COVID came and we had to close, we needed to get some liquidity into the business. So we borrowed some money short term. So we borrowed 60,000 euros that's sitting there under other creditors. When the government introduced the ability to be able to warehouse taxes, we availed of that, and therefore our tax liabilities have increased from 20,000 to 70,000 euros. Also, coming into 2021, we felt, I suppose, positive about the business. We had some money in the bank, and therefore we invested 100,000 in the business, or our building and equipment went up by 100,000 euros. And because we were interest only on our bank loan, we were able to build up some cash. And therefore, at the end of, coming in, I suppose, to 2022, our cash balance is up at 90,000 euros. So we feel we have more cash in the bank than we ever did. We feel that we're in a comfortable position. But I suppose what we're cautioning here really is that you have to forecast that out as to where will that cash position be in a year, in 2 years, in 3 years, especially if the business has changed, whereby it's not as profitable as it was pre-COVID.
Yeah, okay, and that's a good point as well. And actually, when you look at the balance sheet and you see that the total assets has gone up obviously to 1.2 million, I think you're right. It's looking at the cash flow, because that might look positive, but it's the impact of that on the cash flow. So here we have the cash flow going out now for the next 3 years, 22, 23, and 24. So tell us, I suppose, what this business is planning on doing or looking to do to manage its cash flow.
I think in terms of the first thing we're looking at is its EBITDA number. So that was over 200,000. It's now 95,000. If it resets at that level and grows by 3 or 4% per year, well, then we can see, I suppose, the kind of money that will flow into this business each year over the next 3 or 4 years. But we can see, I suppose, the difference between, I suppose, profit and cash flow. So what's the requirements of the business? So each year, to keep the asset in good condition, we have to invest 3 or 4% of our turnover in capital improvements and capital replacements. So we need 28,000 euros in 2022 for that. Our loan needs to be serviced, 21,000 euros for interest, and we're now back on interest and capital with a further 28,000 euros. So we can see straight away that while we're making 95,000 euros, we're really only adding an extra 6,500 euros to the business cash at the end of the year from operations. Now, we have to deal with some legacy issues in terms of the short-term loans that were brought on board, 60,000 euros, and the plan is to pay this off over 2 years. And they were short-term loans, they're looking for their money back. And equally, the warehouse taxes will kick in to be repaid in 2023 over 2024. So our 50,000 euros is budgeted to be paid back 35,000 next year and 15,000 the following year. So when we look at, I suppose, this level of cash flow in and out of the business, over the 2 years, what we see is while we started with 90,000 euros of cash, we fall to a level of 5,500 euros, which is very tight for a business of this scale, and really emphasizes the need for our EBITDA figure to be to grow at a quicker pace. And I suppose it puts the pressure back on us to say, well, how can we look at increasing revenues through higher volumes or higher pricing, or reduce our costs within the business. So a real focus, one, on the P&L is required, but equally, I suppose, seeing, what could happen with cash at bank here. We may need to look at kind of our plan for repaying the promoter loan and repaying the warehouse loan in terms of maybe stretching out those repayments. Okay,
so what you're saying is, while we're going to focus on the costs and revenues from the P&L perspective, from the cash flows, those loans and that warehouse tax, you said there, understand the interest rates and potentially look to extend those. So when you say understand the interest rates, what do you mean by that?
So I suppose we know the warehouse taxes will probably attract an interest rate of between 3 and 4% with revenue. The other loan, the short-term loan, could be more expensive. So there's probably a trade-off for us to look at in terms of what repayment plan the short-term loan people might look at. Would they stretch over 3 years or 5 years rather than 2 years? And equally, what repayment plan would the revenue look at? Will they go from 2 years to 3 years? And I suppose in terms of those two scenarios, depending on, I suppose, the funding costs for that, we might decide whether to pay one off sooner than the other, or delay one or the other as such. But equally, the staggering of those payments is very important on the basis that we need to retain enough cash to be able to sustain the business. And if we find that things improve quickly, but certainly with revenue, at any point in time, we can go in and pay off the arrears with no penalty.
Okay, Thank you, Aidan. Okay, so let's maybe look at managing our cash flow in a little bit more detail. Like you've talked there a lot about both revenues and costs. So obviously that's ultimately the way that we need to increase the EBITDA, is increasing revenues and trying to drive down that cost base, even on a percentage basis. Increasing revenues, for restaurants and bars and pubs, if the level or numbers of people aren't there yet, it's really about increasing the average check and yielding where they can. And I suppose, I suppose it's really, are they tracking that information at the moment? Like obviously a lot of well-performing and good operations do track the average spend, do know what their not spend per customer, but even per transaction is, but does everybody? And I think that would be an important one. And there's a lot of KPIs and a lot of metrics for the food and beverage industry that I think from a financial performance revenue perspective that I think businesses could look at and really try to analyze their business so that they know how they can increase their revenues. But let's look at costs. You had mentioned a few costs that you see going up that'll definitely impact restaurants and bars in particular. Do you want to maybe just take us through a couple of those?
Yeah, I suppose like what we call out, I suppose obviously the payroll cost. What are we seeing? They're probably 15% higher than they were pre-COVID. And we look at, I suppose, our pricing, and it may not absorb all of that 15%, and therefore some of that falls to be absorbed through the profit line within the business. Energy prices are probably growing at 20-30% per year for 2021, and the same again in 2022. And certainly that's a cost that can't be passed on in terms of higher prices, and therefore if we're looking at energy costs, we have to think about ways, well, how can we consume less within the business, and that would be very important for us. Other costs like insurance costs, fewer underwriters maybe looking at the food and beverage hospitality sector, and therefore costs are higher there, and that can be more of a long-term project in terms of how we, I suppose, deal with mitigating, I suppose, the risks in terms of reducing the number of claims and managing out claims that might happen, I suppose, within the business. Because certainly, I suppose, we're seeing double-digit growth in terms of insurance costs, for probably 2021 and 2022. So the level of cost increases is certainly going to eat into profitability of the business, and therefore I suppose we need to mitigate these areas where there are very high cost increases by other measures.
Okay, thanks. So maybe we'd actually just talk through those now, like ways of reducing costs and I suppose making a recovery this year and going into the next number of years.
I think in terms of the first thing I would say here is we need to know the costs of the business. And then when we know, I suppose, all of our cost lines in detail, we need to focus on, what quantities of items are being consumed within the business. And then we need to look at ways that can we reduce the quantities of what's being consumed, can we substitute something or can we eliminate something? So keep asking ourselves questions as to find ways to reduce, I suppose, the quantum that's being consumed, I think, within the business. Secondly, then I suppose in terms of focusing on rate being paid, so how often do we retender? How often do we benchmark prices against with other restaurants who we would be aware of? Can we join buying groups? So can we get the actual rate down by being, I suppose, a little bit more on the front foot? And labour, as we saw, was a huge cost. It could be over 30% for most of these businesses. And it's going to be a limiting factor. We can't do what we were doing before. So we've got to look at ways of reducing, I suppose, the labour or the work within what's happening. Part of that could be, for instance, in terms of opening hours. Are there times where we're not really making a profit? Do we curtail those opening hours? In terms of kitchen, and produce, Can we look at buying in more prepped food that might reduce the kitchen labor? So are there ways in terms of bringing automation into the business as such?
Those are some good ideas, I think, as well. Like, I think one of the challenges for the sector, and they tell us this, when we talk to our clients, is getting staff. Like, so while they're trying to reduce their labor costs, they actually find it hard to get labor. Are there any initiatives that hotels, that restaurants and bars can use, I suppose, to maybe manage their labor some more? Like, I know that hotels will use software, will use technology, will use planning, HR planning tools, payroll tools. Like, so restaurants and bars could use those either. Is there any other ways that maybe they can, reduce their reliance, I suppose, on payroll? What do you think, Aidan?
Yeah, I think in terms of, I think there are technology solutions, and I think it's about, I suppose, finding what's right for the particular food and beverage outlet, because scarcity of labor, there's got to be a work around that as to how do we reduce the work, I suppose, within the business and yet recover the revenues.
Yeah, I think, like, we talked about, I stayed at an airport hotel, and they used the tabletop tablet. So there was one server in that property, and it was fine for the type of offering that I was getting. I ordered off the menu, the tablet, and I paid, and then I was just brought my food and beverage. So I think you're right. It's looking at technology as well, if there's any ways that that can help from a cost perspective. So what's next for this sector? I suppose, are there key actions or takeaways that food and beverage operations can use? So preserve margin, but understand value. I think that's a key thing as well. Like you're saying, look, you really want to manage your margin, manage your profitability percentage, but understand the value that you're offering and the value that's in there. Obviously, trying to pass on the costs at some point, what does the value mean to the customer? Cost management will be ongoing. I think that's what you're telling us, is that, we just have to constantly look at costs and manage our costs, and every cost, I suppose, going back to the value as well. What value does a cost give to your business? Project out and forecast continually. Like we talk about that all the time, and we tell our clients to do that all the time, is, we set budgets and they're historic, from historic numbers, but we need to forecast continually, because that's real-time cost. That's what we're seeing now. So we understand what's going to be the impact, and if we can make changes, as opposed to always just looking back. Passing on costs where appropriate. You said that earlier, Aidan, that there are costs that they will be able to pass on, and then if they're not able to pass on certain costs, like, can they reduce them, or can they reduce in other areas to help mitigate against that? This is something that you've talked about, is a point spending controller. What do you mean by that?
I think, in most businesses, spending is probably under the eye of the accountant. And I suppose businesses believe, look, their cost base is pretty tight when we talk to them. But finding, I suppose, a fresh pair of eyes, somebody else senior within the business who looks at costs, again, and looks at, I suppose, the quantum of what's being consumed and spent within the business, we find that will come up with ways, to create savings, to reduce waste, to substitute items which bring down the overall cost, to eliminate certain items without, I suppose, impacting on the customer experience as such. So in some ways, in terms of items, going back to sustainability, if we measure, what energy is being used and when the energy is being used, whether it's gas or electricity or water being consumed within the business, we will find ways to reduce the consumption and bring the cost down for the business. And the technology to be able to measure and monitor that is becoming cheaper all the time. So there will always be areas where we can change things up. We can re-engineer the business a little bit, and squeeze more margin out.
Okay, so I think what you're saying as well is like don't be complacent, or don't assume that you manage everything really well. Like obviously, you know, food costs, beverage costs are a key area for this sector, but really don't assume that you're doing everything really well. Go back and look at it, and maybe look into something like a Lean or Six Sigma processes that maybe might help from an efficiency perspective, and certainly help reduce waste. What about drafting a cost mitigation action plan? What do you mean by that?
This is what we see when we talk to businesses, is that, you know, reviewing costs, I suppose, and enthusiasm about that, it can be great. But unless, you know, we actually reduce the cost mitigation plan to writing, you know, that somebody takes ownership of it, and it becomes, I suppose, a living plan within the business, you know, it probably doesn't achieve the objectives that it's looking to achieve. So, like, you know, while the easy answer to a lot of this is just increase your prices, you know, what we're saying is, you know, it's only one of a number of levers that you're looking at, and therefore, I suppose, by you know, committing to recording what your costs are, tracking costs in real time, reporting on those costs in real time, and you know, people understanding the impact of items which are being consumed in the business on the P&L, that all of that awareness that you're creating, you know, within the business will lead to savings, because, you know, it's very evident for people, because once it's been reported on, and there can be very simple metrics that you can do to report and feed back that information, so people feel that, yeah, they're playing their part in, I suppose, you know, reducing the costs, making the business more successful and sustainable, because everybody recognizes, I suppose, higher costs, you know, is a big problem for business at the moment.
Okay, thank you. Well, that's some really good information, and I think we've gone over a number of things today that will really help actually with even just looking at the profitability level and planning out how a business can look to try and maintain and improve that. So thank you very much, and I think we will hand back to Aileen now.
Thanks, Aidan and Maria. And just to finish up, I'd just like to thank everybody for listening today. Just to let you know, our next webinar will be taking place in the autumn, where we will delve into more issues and topics that are facing you at that time. Thanks a million to Crowe and Aidan and Maria for a really informative session, and all of those practical hints and tips and really great advice for businesses. And lastly, from myself, please keep an eye on our Business Supports Hub, which is constantly being updated, as well as our national schedule of supports, where you will find all of your training needs. Looking forward to seeing you next time. Thank you.